All right. Thank you everyone for coming to our Create Great Credit class today. My name is JC Finley. I'm the engagement specialist at Denver Community. So first, before we dive into credit today, I like to start off with what is a credit union? If you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and other services to our members. Credit unions are owned by their members, so they have a say in how the credit union is led and operated. Every member is an owner, and it's a democratic financial institution where members can vote for our volunteer board of directors to be able to have a say in how the credit union is run. And the credit union difference is we are for people, not profit. This little diagram is just an example of how credit unions work. So you deposit your money with us. We use that money to make low interest loans to other members. Profit made from those loans is not sent to shareholders or anything like that. It's put back into the credit union and returned to you as better rates and fewer fees. Our goal is to serve our members. We want to provide financial opportunities for our community. A little bit about Denver Community and who we are. Our mission is to educate, deliver, and achieve. So like I said earlier, we provide financial education to help our members reach their goals. We are a not-for-profit financial institution, and we've been serving Metro Denver since 1934. So we've been around for a while. This class is a part of our free award-winning financial education program that includes our live classes and coaching, e-learning courses. Excuse me, sorry, my slides are skipping. Those e-learning courses are available in both English and Spanish. And we also do have financial coaching that's available by Zoom or phone to answer your personal finance questions. And that can be building your credits, pulling your credit report, budgeting, paying down your debts, anything like that. This is just a sample of our e-courses page. There's a lot of different stuff in here. If you're looking to buy a home, lots of good courses. They're just about 3 to 7 minutes, so they're not super long. I'll ask you some poll questions. They're pretty engaging. So if you're looking for some free online financial education, this is a really good resource here. Another thing to mention is there's no login or download or sign in required. You just hop on and can start the e-course. So before we hop into the content for today, we're going to familiarize everyone here with some credit terminology and vocabulary. So we're going to look at 4 people's credit situations. So Brad here has 0 trade lines or lines of trade. And when you hear me say a trade line, that means any open and active loans, credit accounts, or lines of credit that are actively being reported to the credit bureaus. We'll also be discussing different loan types today. So there's 2 different types we'll discuss. So the first one is revolving loans, and these are like credit cards, overdraft lines of credit, and other lines of credit available to you where you're given, a set dollar amount and you can use up to that every single month and then pay it down. So it's constantly revolving. There's also installment loans, which is any loan paid in installments over a specified term. So this is going to be like a mortgage or a home loan, an auto loan, personal loan, any of those traditional loans you might think of. So basically you have your monthly payment, you make that same monthly payment every month until the loan has been paid off. Normally it's, 3, 5, 6 years maybe, or if it's a mortgage, 15 or 30. Brad has had 2 inquiries in the last 6 months. And an inquiry is when a financial institution or a company checks your credit. So soft inquiries are typically for background employment or for housing purposes, and you're not penalized for pulling your own credit report or score for your own education. Always ask utility companies and someone asking permission to pull your credit if it will be a hard or a soft inquiry, because that can impact your credit score. So that leads us to hard inquiries, which is typically when a financial institution is going to check your score. So normally if you apply for a loan, which would be a hard inquiry, you'll see about a 3 to 5 point drop in your credit score about a month later. And that will happen regardless of if you don't open it, whether you're approved or declined for the loan. There are some exceptions for auto loans and mortgages. And what that means is you have a 2-week window, 14 days consecutively when shopping for a mortgage or an auto loan to apply at as many credit unions, banks, mortgage lenders, anything like that as possible over those 14 days. And it will only count as one inquiry. And the reason that is there is a benefit to the consumer. So you have the ability to rate shop and find the best rate for you over that 14-day window, but just really make sure you're within those 14 days, because if you do go outside of those 14 days, it will count as a new additional inquiry. Next, we have Greg. Greg has some unpaid collection accounts. And so this is a debt owed to a lender or a company that's been 180 days late. And then once it hits that 180-day mark, these lenders will sell this debt to a collection agency. When these lenders sell this debt to a collection agency, it's going to display as a new additional negative account on your credit report. So if you can, it's better to fix and adjust those late payments with the original lender or company rather than waiting for it to go to a collection agency, because you have that new negative account on your credit report at that point. Any collection account will be damaging to your credit score regardless of the balance owed. It could be $25, it could be $2,500. Both are going to be damaging to your score. And by paying off a collection account, it will significantly improve your credit score. And later we're going to dive into the different factors that create a credit score in a bit. Greg's length of credit history is 72 months. So in general, you need to have at least one open account that's been reporting to the credit bureaus for about 6 months to have enough information to generate a solid credit score. The longer you have a positive credit history, the better the better a lender can know about you and your spending habits and if you're likely to pay back the debt or not. Next, we have Helen. Helen has 39 trade lines and 24 paid accounts. She is current on her mortgage. So that just means when it's current that it's paid on time, it's not late. Helen has about $10,500 in credit card balances, so things that she still owes, but her total available revolving credit card is about $70,000. So right now she's using about 15% of all the credit she has available to her. She has no delinquent accounts, so nothing in collections, and no late payments. If you do have a late payment that's reported to the credit bureaus, it can stay on your credit report for 7 years. So it's a long time. I don't want that to scare anybody because, late payments happen or auto pay doesn't work for some reason. Typically, late payments are not reported until being 30 days or more late, but not always. It will depend on the lender or company. If you do have a late payment and if it's an accident, typically your score will go up the following months as long as you continue to make other on-time payments and your other credit usage remains the same or consistent. Next, we have Sarah. She's our last person we're going to walk through today. Sarah filed for bankruptcy in 2019. Bankruptcy is typically a last resort legal process, and medical debt is a top reason for bankruptcy filings in the United States. Sarah's had 9 inquiries in the last 6 months. So that means she's tried to get credit 9 different times over 6 months, which is quite a few, more than I would recommend. And Sarah is also maxed out on all of her credit cards. When we say maxed out, that refers to credit utilization and looking at that percentage of the limit you've used on a revolving loan. So if we think back to Helen from one slide ago, she was using 15% of her credit utilization there. And what maxed out means is at or above the limit of a credit card or line of credit. So Sarah's credit utilization here is probably at 100%. She's probably using all of the money available on her credit cards there. But Sarah hasn't missed one payment since bankruptcy. So that is one thing she has going for her. So as we walk through this class, keep these 4 people in mind, and later we'll discuss who has the best credit score. So a quick poll question here, and you can just respond in the chat box if you're able to. What is the best definition of credit? Letter A, credit is a number that lenders use to determine whether to give you a loan or not. Or B, credit is confidence in a borrower's ability and intention to repay. A or B, what do you think? Got one person that said B. I got a couple B's, and B is correct. If I can get my thing to skip here, there we go. So credit, the overall concept of credit is just, is someone going to pay back or not? The definition of letter A is actually a credit score. It's that physical number that lenders will look at. Thank you to those who participated. So looking at our credit reports, what's in a credit report? You're going to find a lot of information in your credit report. So this is going to include your personal information, such as your name, social security number, birth date, address, and your phone number. I did have a question come through the chat box. And I think I'm gonna wait to answer this one to the end. So thank you so much for your question. I'm gonna wait till we get to another part of the class to address this one. But thank you, and I will address this in just a little bit. Also in your credit report, you're going to find your loan account information. So open accounts, accounts that have been closed in the last 7 to 10 years, dates that these accounts were open or closed, payment history, credit utilization, account balances, and loan payment statuses. So if you're not ever sure, if you have a balance on something, or you want to know what the original limit was on a card, pulling your credit report would be a good option for you. It will also include public records such as bankruptcies, foreclosures, tax liens, and civil judgments, and then your inquiries. And an inquiry can also be called a hit on a credit report, and this happens anytime a report or score is pulled, and we'll discuss more details about that soon. Remember that businesses, including lenders, do not have to report to the credit bureaus. So in order for something to work and build your credit score, it has to be reporting to the credit bureaus. So if you're looking at getting a new loan or credit card, always ask, hey, do you report to all 3 credit bureaus? And just ensure that they at least report to 1 or 2 of them to help build up your score. It's not uncommon that not every business or lender will report to all 3. There are 3 separate credit bureaus, and remember, these are for-profit companies. So if you were to go to these individual websites to try and pull your credit report, they will try and charge you a fee. We'll talk about here in a second how you can pull your credit report for free with no charges. The 3 credit bureaus are Experian, TransUnion, and Equifax. I would say Experian is the most commonly used out here in Colorado. It's also my favorite because you can get your free credit report through Experian each month if you create an account with them. And as I mentioned, credit scores are based only on the information in your credit report. So that's why it is so important that they report to the credit bureaus. This is just a sample credit report that's very condensed here. If you were to pull your own, I'm sure it would be much longer than this. But the first area you're going to see, that's where all of your personal information is going to be. You do want to look over your credit report. You do want to look over your credit report pretty thoroughly. And the reason for that is because about 20% of Americans do have some sort of error on their credit report. And it looks like I have someone possibly drawing on the presentation. If I could just remove that or get someone to remove that, please. Got that gone. The second area, these are going to be those public records. So any tax liens, civil judgments, bankruptcies, that's where you're going to find those. Third is the collection area. So if you do have any collections, you'll find them here. As you can see, they have one here, July of 2018 for $500. This area will also provide you information with how to contact those collection agencies to get that debt paid off. Area 4, that's where you're going to see all of your trade lines and account informations, loans, credit cards, mortgages, anything like that. As you can see here, they've got a bank card, an auto loan, and probably a retail card here. Lastly, you'll see your inquiries. It will include both hard and soft inquiries. So some that impact your credit score and some that did not. So for the cell phone issuer, I'm guessing that they did not have a hard inquiry there, but for the card issuer, I would guess that was a hard inquiry and it did impact their credit score. This is just a brief sample of what to look for in your credit reports. So as I mentioned, mistakes are rather common on credit reports. To pull your report for free, this is a great resource. Go to annualcreditreport.com for free credit reports every 12 months. Due to the pandemic, they have shifted and reports are available weekly through April of 2022, which is next month. So I highly recommend pulling your credit reports if you haven't already for this year. The reason they're offering them more frequently is because fraud and scams were also higher during the pandemic. So making sure that this is an accessible resource for people to ensure their credit and information is safe. Through annualcreditreport.com, you can dispute errors and any inaccurate information and have it removed for free. So it can be small things like, maybe your birth date is incorrect or it's not an up-to-date address, or it could be more serious things like accounts on your credit report that aren't yours. And so we're going to walk through the difference between credit report, and a credit score in just a little bit. So I like to use this T-chart here to talk about different products and things that we might buy or places we might shop, and is credit important or not? So the first one is a checking account. And a checking account here goes in the middle. There will be a couple that go in the middle here. Some financial institutions, banks, or credit unions will check your credit score before you're allowed to have a checking account. So that is one important thing to think about when looking for a new credit union, bank, or financial institution, is just ask if they do a credit check upon account opening. At Denver Community, we do not do a credit check. The next one is getting employment. Getting employment also goes in the middle. I think it heavily depends on your career path and what industry that you're going into, but having a good credit score can help you get certain jobs, or it may be checked before getting a job position or a job offer. Next is a payday loan. And credit is not important for payday loans. Although it has the name loan in there, payday loans do not check your credit and oftentimes have very, very high interest rates. They are oftentimes more predatory and prey on people who are in a time of crisis. And with these high interest rates, it makes them very difficult to pay off. And oftentimes it becomes a vicious cycle of getting a payday loan to pay off a payday loan and just repeating that process over and over. So I recommend avoiding payday loans if you can. Reach out to your financial institution to see if they have an emergency loan or anything like that available to you. Next is a renting apartment or a home. Yes, credit will certainly be important when you find a place to rent. A lot of either landowners or apartment complexes will want to see your history of repaying before you sign your lease. So having a good score can certainly help you get a place to rent. It can also save you money by having a strong credit score on your deposit. Next is an auto loan. And yes, credit will be very important for getting an auto loan. Anytime you want to get an auto loan, we will check your credit score. So having a good score can really help lower your interest rate and how much you'll be paying in the long run over the life of that loan. And we'll go through an auto loan example here in just a little bit. Next one is a pawn shop. And credit score is not important for a pawn shop. As long as that pawn shop has your item of collateral that they can sell if you don't pay back, they do not care about your credit score. Now, what about a rent-to-own store? Rent-to-own. This one also goes in the middle. We used to have this one on the side of credit is not important, but we did have a couple members who mentioned that their score was checked at a rent-to-own score. So we did change this one to being in the middle here. If you're not familiar with what a rent-to-own store is, basically it's for larger household things, like for example, a fridge, maybe a couch, TV, laptop, more expensive items. And basically you pay a monthly payment and you rent that item until it's completely paid off and you own it. In theory, this sounds like a good option, but oftentimes these rent-to-own stores do have fees and interest rates on each one of your monthly payments. So you end up paying like twice or three times what the item is actually worth. So if you do use rent-to-own stores, I recommend looking into that. It might be worth just saving up the funds and buying it outright as opposed to going with the rent-to-own option. Next, we have a mortgage or a home loan. And yes, credit will be absolutely important for your mortgage or home loan. I know for most of us, myself included, buying a house is one of the biggest purchases that we will make in our lifetime. So it is very important to make sure you have a strong score going into the home buying process to help you save money. And then lastly is auto insurance. Is credit important for auto insurance? And yes, actually by having a strong credit score, it can help to lower your auto insurance premiums, which is something that I did not know before taking this class. Now we're going to dive into our FICO credit score. And so FICO is the most commonly used scoring model. It's used by about 90% of lenders throughout the US. And the higher your score, the better. These scores are going to range from 300 all the way up to 850, 850 being the highest score possible, 300 being the lowest. And when you do start building credit, they don't just throw you to the wolves. They don't put you at that 300 and you have to work your way all the way up. Like I said, after that 6 months of using credit, you'll normally get a score somewhere in the middle based on how you've been using it and if you've been using credit responsibly. This FICO score is based only on the information in your credit report. I just really want to emphasize that throughout this class. You will have 3 different FICO scores, one from each credit bureau. So you will have one from each credit bureau. You'll have 3 total. That's something that can confuse people sometimes, but that is totally normal to have 3 FICO scores. And sometimes they're a little bit different. They won't all match up perfectly, but that's okay. And your FICO score is based on 5 different categories, and the importance of these categories will vary by person depending on their credit profile. So looking at what types of credit are they using, how long have they been using it, are they using it responsibly, are they maxing out credit cards, and so on. And we'll look through an example regarding this later. So factors that determine a FICO credit score. I would say this is probably one of the most important or most useful slides throughout this presentation. It's really breaking down the makeup of what your credit score is. So payment history is 35% of your score. This is the largest chunk of your FICO score, is just making your payments on time. So when we talk about this, we're going to talk about how recent was your most recent delinquency. So your late payments, have you had a collection? How severe was that late payment? Was it 30 days late? Was it 90 days late? How many of your credit lines or trade lines have been delinquent? Was it just one time, or maybe your auto pay didn't go through, or were you late on everything that month? On-time payments to installment loans, for example, home loans, personal loans, auto loans, will help your score a little bit more than on-time payments to revolving loans like credit cards. And building credit will take longer if you only have one account open, but I certainly do not recommend getting into costly debt to build credit because there are many affordable ways that we'll go over. Credit utilization, that is looking at your outstanding debt. So credit utilization, this is where those collections will come into play. So 30% of your score, if you can get those collections paid off, that's significantly going to help your score there. Also, credit utilization refers to what's your outstanding balance on those credit cards. Are you keeping it low around 10, 15%, or are you maxing it out and putting 100% of that balance on those credit cards every month? Length of credit history is 15%. So in this category, we're looking at how long have your accounts been established? So how long have you just been using credit in general? And also the average number of months an account has been open. So that is one thing to think about. You don't want to open a lot of new credit at one time because that's really going to shorten the average length of your credit history. It also takes into account any new accounts that you've had and the number of months since opening your most recent account. So like I said earlier, whenever you apply for a new loan, such as a credit card, auto loan, it will drop your score that 3 to 5 points, but your score should bounce back in the next month or so. Amount of new credit, this is 10% of your score. So this is looking at your inquiries, the number of credit inquiries over the last 12 months. Any new accounts, the number of trade lines that you've opened in the last year. And then lastly, types of credit in use, 10%. That's looking, they do want to see a balance of both installment and revolving loans. And the last 3 matter here, but really focus on those first 2 that we talked about, payment history and credit utilization. Oh, I had a really good question come up here. Does closing an account impact your credit score in a negative or positive way? Great question. When you close an account, the same thing is going to happen when you opened the account. So when you close a credit card or pay off an auto loan or pay off a mortgage, it's going to close the account and it will drop your score about 3 to 5 points. Just anytime you open a new line or close a line of trade, it will drop your score that 3 to 5 points. So that's a great question to ask. It is kind of unfortunate. I know for me, I pay extra on my auto loan every month so I can pay it off sooner. So it is unfortunate that I will have, my credit score go down a little bit. But as I mentioned, as long as you keep all of your other credit obligations consistent, like you're making on-time payments, you didn't open up, 6 new trade lines, things like that, your score should remain about the same, or it should go up that following month. So you may see a slight dip if you close an account, or pay off an account, but your score should go up in the next month or so, as long as everything else stays consistent. Great question. So if we think back to our 4 individuals we discussed at the very beginning, we had Brad, we had Greg, we had Brad, we had Greg, we had Helen, and we had Sarah. So we had all these individuals. Who would have had the best credit score? You can send an answer in the chat box if you can remember. If not, that's totally okay. I had another question come through that I thought was a really good one to address here is, can you report your rent payments to a credit bureau? And so that is a great question. Unfortunately, since this isn't a line of trade, it's not actively being reported to the credit bureau to help your score. But if you were to miss a payment and let's say your landlord were to report it late, it can damage your score. There is this new thing that Experian created called Experian Boost. And if you make an account with them, you can use, I think it's utility payments like phone bills, utilities for your apartment or where you live, and those can help to increase your credit score. I personally did use it. I wanted to make sure that it worked before I shared it with our members and at our classes. So if you go to Experian, they do have an option for Experian Boost, where you can enroll phone payments and utility payments to actually help increase your credit score. I'm not sure if rent payments are a part of that or not at this time, but that is one option that Experian has to help boost your credit score if you don't have a lot of lines of trade. So I'm not sure about rent payments, but I know through Experian Boost, you can do utility payments and phone payments. So great question. I had a couple people respond here. I had someone say Helen, someone say Sarah. And the answer here is Helen. Helen would have had the best score since she was current on everything. Everything was up to date. I did have someone here in the chat box mention about Experian Boost, that it does not work with all financial institutions. I will say it has worked with Denver Community for me, and I worked with a couple other members as well. But that is a great point to bring up, that Experian Boost may not work with all financial institutions, but I do know that it works with Denver Community. So thank you. Great point to bring up. A question that I'll get very often is having a credit score the most important financial skill? And I like to say, you know what? No, credit is an important tool in your money management toolbox, but it's not the only tool available to you. Manage your money in a way that helps you reach your financial goals and also aligns with your values. So this is that auto loan example I mentioned earlier. So these are not our current loan rates, but just an example for the purpose of this class. Our website also has some calculators that you can use if you want to check out some loan examples or figure out what your payment might be. But this does show you kind of the ranges of credit scores and how it's going to align with different interest rates. So you can see if you have a 740 or higher, you're going to have a 4% interest rate, 720 to 739, 5%. And you can see that the interest rate goes up as we go down the line here. So to hop in this example, we have someone that has a 4% rate versus someone with a 17.25. So maybe they just had a poor credit score or maybe no score. And they have the same loan, $10,000 over the course of 5 years. And you can see their monthly payments differ a little bit, about $65. But when we look at the interest paid over the life of the loan, we're looking at almost $4,000. And I'm sure we could all think of $4,000 worth of things or places we'd like to travel, that we'd like to spend our money on, as opposed to interest on a loan. So overall, good credit is about keeping more of your money and not spending it on interest charges, fees, and additional security deposits because you may be seen as, quote, high risk. Now, is it possible to have a good credit score if you don't use credit? It's a good question. No. Someone who does not use credit would just have no credit scores. They wouldn't have a 300 or a 400. They would just have no score. And so, like I've mentioned several times, I just want to emphasize this. You need to have those regularly reported on-time payments to build up your score. And it will take about 6 months to build a FICO score or a strong score. You should get a score after the first few months of making your payments, but after 6 months, they'll have enough data to create a strong score for you. You can be considered a risky.
It's amazing.
Sorry about that, everybody. You can be considered a very risky borrower if there's no history or data of repayment behavior. So that's why those lenders like to see your loan that you've paid back your loans. That's why they check your credit report. They just want to see that you've paid other lenders back before to have a good assumption when they're giving you this loan that you're going to pay your monthly payments. So this is an example of 5 different people with different FICO scores. And on the next slide here, so I'm going to give everyone a chance to kind of take a look at this, absorb some of this information. And on the next slide, we're going to look at a series of different credit actions, for example, missing a payment or taking out a new loan or paying off their credit card debt and seeing how this impacts their credit scores. So you see we have Rachel, Sophia, Mike, David and Maria. They have different credit utilizations, different revolving balances. Some of them have long credit history. Some of them don't have very long credit history. And they have varying scores here. So we're going to jump to this next slide here and see how these different credit actions will impact their scores. All right, so you can see we've got everyone's scores here at the top and this list of credit actions. You can see missing a payment by 30 days, how that will impact their score. Missing a payment by 90 days, you can see that's going to impact their score more heavily than the 30-day late payment. Reducing their revolving account balances by 25%. So that just means paying off 25% of what they have on their credit cards or overdraft lines of credit. Taking out a new personal loan, and then maxing out credit cards. And as you can see, everyone's score is impacted slightly differently. So for Maria, it's most damaging to, I think actually for everybody, it's almost most damaging to max out their credit cards. But by looking at these different accounts, you can see how everything's impacted differently. So it's very hard to tell if someone asks me, hey, if I make a 30-day late payment, what's going to happen to my score? I'm not quite sure just because everyone's credit makeup is very different. So this is just a good example here. So now we're going to talk about building or rebuilding your credit affordably. So a few strategies. For the highest credit score possible, keep your revolving loan balances, like credit cards, up to 10% of your credit limit at all times. So an easy example here is if you have an $1,000 credit card, only use $100 or less of that each month for the highest credit score possible. Set alerts to stay on track or pay down your balance multiple times a month. So if you know you're getting to that, 10, 15, 20% mark, you can pay down your credit card balance multiple times a month. That's totally fine. Pay any credit card balances in full at the end or whenever you get your statement every month to avoid paying interest, which is a finance charge. I would say the most, responsible and beneficial way for your credit to use credit cards is put 10% or less on there of your limit each month and then pay it off. Pay off the full balance. Don't leave anything left over. There was this rumor going around for a long time that you had to carry a balance on your credit card to increase your score. And that's simply not true. You can put money on there and then pay it off every month, and that will certainly help to build your credit score. I have a question here. How does paying down your balance multiple times a month help and increase your score? So I wouldn't say that you have to pay your score down, pay down your balance multiple times a month. What I was saying there was more so if you notice that you're getting above that 10%, you can use up to 30% of your credit card limit too. And that's supposed to keep your score fairly consistent. But let's say you have a really big charge that goes on there. You wanted to buy a new TV this month. So you charge it, you have that, let's say it's a $600 TV and your credit scores or your limit's only $1,000, you're sitting at 60%. So if you can't pay down that full balance at one time, you can pay down that balance through multiple different payments. So that way your credit card isn't sitting at 60% credit utilization all month. So you can pay down your balance if you notice it's starting to get high. So that way your credit utilization won't be, above 30 or so percent. So great question. So going back on that one. So for example, if you have a loan for $350 and you pay the monthly payment plus an additional $10 payment, does that help to increase your score? I would say probably not. It wouldn't necessarily help to increase your score. You would, pay the loan off sooner by adding those small additional payments. So yeah, great question. Another question that I got in here was, how does co-signing affect your credit? And co-signing will impact your credit just like if you were applying for the credit. So let's say if you were going to co-sign on your son or daughter's auto loan, your score would be impacted just as theirs would. So you guys would both have this loan on your credit report. You would both have your score impacted. And the biggest thing with co-signing is basically if your son or daughter were to miss their payment or stop paying on this auto loan, the responsibility falls on you. So that is one kind of quote unquote scary thing about co-signing is if this person stops making their payments, it will directly impact your credit as well. So if they miss a payment, it's the same as you missing a payment. But if you know they are a trustworthy individual and they're going to make their payments on time, it will actually help your score just as it's helping their score. So by co-signing, you're basically just taking on that responsibility of the loan as well and being a backup if that person were to stop making payments. Great question. Does co-signing impact the amount of money that you can borrow? So yes, it can help. So for example, if you know someone or maybe it's your son or daughter who are trying to get their first car and, they're working a minimum wage position or working at Target or something like that, having a co-signer can help increase the amount that you can borrow. So yes, it can help increase the amount that you can borrow by having a co-signer. Great question. A few tools that you can use for building your credit. And we're going to walk through all of these. So secured credit cards, credit builder loans, and unsecured cards that have no annual fees or low fees, like $25 a year would be reasonable. I wouldn't pay anything more than that to just use a credit card every year, but that's just me. So first, we're going to talk about the credit builder loan. So the best way to describe this one is that you're building savings and credit simultaneously at the same time. One question we got here is for starting to build credit. How would you say is the easiest way to start building credit if you have absolutely no credit to date? Honestly, any of these options that we're about to walk through would be great options for you. We have the credit builder loan, which is set up a little bit differently. It's an installment loan. We also have our starter Visa card, which is for someone that has had no credit history. So we're going to walk through some different options, but any of these would be a great start for you. Another question we had that's a really good one is, how do student loans affect your credit score if in deferment versus making monthly payments. So right now, all federal student loans are in deferment, I believe through till May 1st of this year. So you do not have to be making any payments on those, and it's not negatively impacting your credit score. So basically by these loans being in deferment, it's like you're making all of your payments on time. So it's not hurting your score by being in deferment. If you make monthly payments on your student loans, I wouldn't say it's necessarily going to help or increase your score, but it's going to help pay down that balance sooner, especially since they're not accruing interest right now. That's one really good thing, is if you are able to make payments on your student loans, now's a good time to pay them down. But overall, you don't have to be making payments right now for your student loans to be helping or hurting your scores. So since they're in deferment, it's just like you're making on-time payments. I hope that made sense. Great questions, everyone. Keep sending them in if you have them. So with the Credit Builder loan, you build savings and credit simultaneously. One great benefit about this product is there's no money up front required, and also no credit qualification. So you don't have to have a credit check or pre-approve or anything like that. And we do 2 loan amounts, $500 or $1,000. You get to choose, that's up to you. And we do a 24-month term. I have a little flow chart here that kind of helps break down the Credit Builder loan a little bit better. So first, a member would come in and apply for the Credit Builder loan with absolutely no credit pull. We would open a certificate of deposit for that member. And let's say someone were to choose a $500 loan for 24 months. We would put that $500 in that certificate of deposit there. And then the member would pay back the loan in monthly installments. In this example, would be about $23 a month. And at the end of the loan, the member would get back the funds, which would be that $500, plus any interest that it earned sitting in that certificate of deposit. So you would, So you would be receiving more than $500 back. I know certificate of deposit rates are not super high right now, but it would be earning something. So that is one benefit of the Credit Builder loan. And there is an interest rate on there. It is 10%. So that is something to be wary of with the Credit Builder loan. But overall, it's a great product for building your credit, and it is an installment loan. So it can help you build your score a little bit faster than revolving lines such as credit cards. For the person that asked what would be a good credit building product for me if I've never used credit, I think the last one or this starter Visa credit card would also be a really good option. So the starter Visa card is for someone with no previous credit history, so you've never used credit before. But one thing is you must have a verifiable income to qualify. So you have to have some sort of income coming in just to prove that you can pay off the balance each month. The starter credit card limit is preset by the financial institution. At Denver Community, our limit starts at $300. And after 6 months, we will reevaluate that limit to see if it should be increased based on how you've used the card. There is no security deposit or money down for this one either, which is a great benefit. And we also do provide a little financial education course to answer any questions and to ensure that you're using the credit card in a way that's going to help your credit and not hurt it. The last product we're going to talk about today is a secured credit card. And basically, you have to provide your own funds or a security deposit to secure this card. So for example, if you want a $500 secured card, you have to put $500 into a frozen savings account. We're not going to take that money, and it's not accessible to you, but it's just to ensure if you were to, max out that credit card and then not pay it back, we would have something on the credit union's end as a security deposit. Exactly. So that is the biggest drawback of this one, is that you do have to have those funds up front to put in that frozen savings account. But if you're someone who does the Credit Builder, saves up to that $500, boom, then you can open the secured credit card to continue your credit building process. Minimum balance will vary for secured cards. $250 is common just because we want to ensure you're using the card in a way that's building your score. 10% of $250 is only $25 a month. So you want to keep those balances low on there. Interest rates will vary for secured cards. As of today, which is March 15th, ours is 12.99%. Watch out for any fees. And no credit pull is required at some financial institutions for secured cards because you're putting up that security deposit. Strategies for great credit. Check your credit report at least annually for free. Like I said, through April of this year, you can pull them weekly at annualcreditreport.com, and you can get all 3 of your reports there. Pay your bills on time and pay off collection accounts. Just those 2 categories right there are 65% of your FICO score. Keep amounts owed low on those revolving lines of trade. So 10% or less of your credit limit for the highest score possible. That's personally what I do every month, is 10% or less. Or you can use up to 30% of your credit limit to maintain good credit. Keep your credit history as long as possible. So you don't want to, close a bunch of cards at one time, because that'll really shorten up your average length of your credit history. Keep inquiries to the necessary and only apply when you need it. I know during the holiday time, retailers really push us to open up credit cards to save money. But if you do that, only open 1, maybe 2. I try and keep my inquiries to maybe 1 every 6 months to a year, or just only applying when I really need it. So for example, if I totaled my car tomorrow, I would certainly be applying to get a new car later this month. And then lastly, having a mix of credit, so both revolving and installment loans if you can. What to do if you know you're in trouble and you know your credit's not doing well? 1, decide to take control. 2, get a copy of each of your 3 credit reports, and we can review those during financial coaching if that'd be something that you'd be interested in. Call creditors at the first sign of trouble. Oftentimes, if a creditor has an open line of communication, they may not report those late payments right away or work out a payment plan with you, so you don't have any late payments reported at all. Fix any late payments and or collections. Like I said, if you do see any collections on your credit report, there will be an area where you can find the contact information and reach out to that collection agency to get that debt paid off. You can also consider meeting with a reputable accredited credit counselor at a nonprofit to learn more about debt management plans. We work with GreenPath locally, so if you're interested in a debt management plan, feel free to reach out to me. I'd be happy to give you some more information on them. You can access your free credit score and report in your mobile app now. So if you are a member of Denver Community, if you go into your the app, click on menu and then my credit score, you will be able to access your credit score. They've got a lot of great features on here. I really like it, and it's very user friendly. It helps you understand your credit health, how to improve your score, and it will also provide you with credit alerts. So new accounts, anything like that. Here you'll get a credit score analysis. You'll find a breakdown of your score into 5 factors, which is things we talked about: payment history, credit usage, account mix, credit age, and inquiries. And so they will also give you recommended actions on how to improve these grades here. So for example, have longer credit history, which that one's kind of hard. We can only wait for time to pass by so long, but these have some good suggestions if you do have some areas of your credit score that need some work. You can also use the simulate feature. So how we walk through those examples of different people and what would happen if they missed a payment by 30 days? What about 90 days? What if they got a new loan? This simulator allows you to kind of play around with your credit score, try around some of those credit actions and see what the impact might be. So I thought this was a really cool feature for testing out what might happen to your credit score if you miss a payment, or if you get a new loan, or pay off a collection account, things like that. So I thought this was a really cool feature to share. All right, we do have about 5 minutes here that I will open it up for questions. So if anyone has any questions, feel free to send them in the chat box. I will keep an eye on that. I also know I had a question from the beginning of the class that I do want to address. So let me find that one quickly as well. If you don't have any questions, feel free to hop off. I thank you so much for your time today and joining our class, and we will have a recording for this available later this week. So thank you again and have a great day.